Hi, and welcome to the 1 p.m. session on equity access through closed-end funds. I am Russell Robinson, and I will be the moderator today. I work for Capis out of Dallas, Texas, and one of my main focuses at the firm has been expanding our closed-end liquidity network. Having traded close to all the 500 closed-end fund names in the past year or two, we offer a truly unconflicted model to sourcing liquidity for our buy-side relationships. This is of interest to you, please, I would love to discuss afterwards. But the main focus of this, again, is accessing equity through closed-end funds. A little overview of our panelists, go in depth to where they think the markets are headed, where they're currently sitting. But we really want this to be an open dialogue between not only the panelists, but those that are viewing. So if you have any questions, please feel free to send a chat my way. And going in order of the boxes, we'll go ahead and introduce our panelists. First is Peter Miletus. I said that correctly, I think.
Yep.
Peter is Vice President of Gold and Precious Metals Research at Merck Investments and is a member of the Portfolio Management Group. He focuses on gold and precious metal companies. Prior to joining Merck Investments, Peter gained experience in research analysts at Franklin Templeton. Peter, thanks for being here.
Thanks.
Next in line, we have Martin Conahan, all the way across the pond near Edinburgh, or in Edinburgh. Martin is an investment director in the global equity team at Aberdeen Standard Investments. Martin has been there since 2001. Martin has held numerous roles as trader, SR analyst on the global equity team. He has also spent 2 years as a portfolio analyst on the fixed income team in London. And lastly, I hope I don't say his last name with an accent, but we have Peter Vanderlee of Clearbridge Investments. Peter is a member of the income solutions team that co-manages dividend strategy products. He's also a co-manager of the tactical dividend income strategy, balanced income strategy, and the LMP Capital and Income Fund. Peter has 21 years of investment management experience and 11 years of related industry experience. Welcome, guys. Thanks for being a part of this. Just to get into it, I'd like for each of you guys to talk about your firm and a little bit about your strengths.
Okay, why don't I start? So at Merck Investments, we took over management of the AICA Gold and Precious Metals Fund in April of last year. The AICA Fund has been around since 1958. That's one of the oldest gold and precious metals funds in existence. Part of the rationale was we went from an internally managed fund to an externally managed fund where the board changed the structure of the fund, and we get a management fee at Merck to manage the fund. Prior to that, as was mentioned, I used to work at Franklin Templeton for almost 9 years as the precious metals analyst, and so the opportunity to manage the fund was a good one to sort of change the way we were looking at things. I inherited a fund that was top heavy in large cap and royalty companies in the gold and precious metal space. And it was a very fortuitous time as the gold market has, after kind of a long slumber over the last couple of years, started to take off due to obviously a number of reasons that going on globally due to stimulus and global uncertainty and virus-related reasons. But during that time, we also changed the focus of the fund rather than run it as a typical kind of index somewhat related kind of fund to a more assertive fund that invested in medium and small cap names and also some of the exploration development companies, taking advantage of the relationships I've developed over the years to within the sector. Traveled globally to 40 countries, looking at assets, meeting management teams, have intimate knowledge of a lot of the companies that are in the space, and also have been dealing with understanding what their financing needs and the like. And so we've been trying to focus on gaining access to companies earlier than the market could in a way that could juice our investment returns. So we've been participating in what's called a lot of private placements, where we buy equity in the companies, and then we also get warrants, which also acts as a form of optionality on the plays that we're investing in. The discount in the fund historically has been quite high. We spent a lot of time marketing recently, trying to get the investors to have a better understanding of how we're doing things and how we're changing. And the market's been pretty good and the performance has been good. So people are starting to gain some notice and traction in how we're doing our investment process. There aren't any really closed-end options for gold and precious metals. You can buy some of the ETFs and the gold ETFs, physical gold ETFs, but those are sort of index related. So we like to think that investing in a positive gold tape, that you will get leverage to the gold price investing in ASA.
Thank you. Martin?
Yeah, I'm Marty Connan. As mentioned, I'm based in Edinburgh. I work for Aberdeen Standard Investments. We manage 640 billion US dollars across a range of asset classes, active and passive equities, fixed income, multi-asset, public and private infrastructure, direct and indirect real estate. I've predominantly been based on the global equity team for the majority of my 22 years with the business. I currently focus on all forms of active global large cap, small cap, and then also income. And then also EFI plus ex-US mandates across the same asset classes. With regards to the closed-end fund space, I'm involved in the management of AOD and AGD, which are two funds which came to ASI back in 2018 from Alpine Funds in New York. My colleague Josh Dietz, who came over from Alpine, is involved in the management of those funds as well. So that's where we're involved in the closed-end fund space, dynamic dividend strategies in a global equity context. We also recently launched a new closed-end fund in the middle of all that's been going on. We felt we were a little cursed with the timing of it, but looking to offer and make use of the capabilities we have. We launched a global infrastructure income fund, but which makes use of our public and private infrastructure capabilities. And we launched that just a couple of weeks ago. Still managed to raise, a couple of $100 million, which, given environment, we felt was quite a positive result. And just trying to offer that private infrastructure capability to investors that otherwise, might struggle to get that exposure. So. That's a little bit about myself and a little bit about my involvement in the closed-end fund space in the US.
Thank you, Martin. And last but not least, Peter Vanderlee.
Yeah, thanks. Glad to be here. So, I'm Peter Vanderlee, and I'm part of Clearbridge Investments. This is an independent affiliate of Franklin Templeton. Clearbridge is an equity long-only active management shop with over 150 billion in AUMs, centered around three investment pillars: income solutions, growth, and low volatility. I'm a managing director and portfolio manager in the income solutions team, which manages around $30 billion in AUMs, and that includes 4 closed-end funds. 3 of those funds are MLP focused, and 1 is more broadly diversified, and that's the one that I will be representing today.
Thank you all for that. We're looking at building out a portfolio. How do each one of you approach this type of strategy or building out your portfolio?
I can start first now. So we have a portfolio in the closed-end space that seeks to provide an attractive current income stream to our investors, and we're doing that with an equity focus. Our view is that bonds at the moment are not very attractive. There's not much income to be had anyway. $15 trillion of bonds currently are trading globally with a negative yield to maturity, so talking about not having income. So we seek to provide that income stream through equities, and we do so in this program portfolio in a very diversified way. So the asset classes that we invest in are dividend-paying stocks. We also invest in REITs. We invest in business development corporations. We invest in mandatory convertibles as well as straight convertibles, and we invest in MLPs. The benefit of that approach is that it is very well diversified. We're not betting the ranch on any individual segment of the equity spectrum or in any individual sector of the market. We're broadly diversified. And we also retain the potential for upsides, given that this is a very equity-focused strategy. So that's in a nutshell how we go about it. It's bottom up, so we are not looking to make an overall asset allocation decision and then kind of do a closet index of these sub groups. That's not how it works. Each and every name gets into the portfolio on its own merits, so it's very bottom up, but there is a top-down view in it to make sure that we stay broadly diversified. We do look for companies that have very strong balance sheets, companies that generate a lot of free cash flow, companies that have a leadership position in their respective sector, and companies that have an attractive income stream, either in the form of a dividend or a distribution, and better yet, have the ability to increase that income stream over time. And that is, in a nutshell, the investment process.
Yeah, I mean, given that it's a global equity, well, two global equity income mandates, AOD and AGD, they're very, very similar, I guess. We are, we're trying to, we don't get overly adventurous in terms of relative positioning around the benchmark in terms of, geographic or industry positioning. We're trying to deliver an absolute return level of around about any global benchmark, but with most of that, coming from income. So, and again, it being a bottom-up process that we also adhere to, we like to try and just let the stock selection, do the talking. So, don't get overly adventurous in terms of relative positioning, but then we'll build a relatively high conviction portfolio. Certainly no more than 90 stocks. Active share of around about 85. And again, looking for a lot of the similar things that have been mentioned already. Now, about 95% of AGD and AOD are typically just long only buy and hold global equity, portfolios. And the running yield on that section of the portfolio is around about 3%. What we do with the remaining 5 to 10% is employ a sort of dividend capture strategy. So we will actively trade in and out of companies carefully and around their ex dates to clip the dividend and trade quite a lot with that 5 or 10% of the portfolio. We'll look to, take advantage of special dividends. We will look to take advantage of, large annual dividends, which come, early first quarter. Late in the first quarter, early in the second quarter in Europe, for example. And that part of the portfolio boosts the overall yield in the fund up to between 7 and 8%. So we have a 95% as a traditional, buy and hold global equity strategy. But with 5 to 10% of the fund, we're constantly working quite hard, trading in and out of names to generate a higher level of yield, which boosts it towards, 7 or 8%, as I've mentioned.
Yeah, so in my side of the a portfolio approach, gold is obviously a most people would say it should be a smaller portion of anyone's portfolio, and historically should be there for a kind of a quasi insurance for what the people perceive the rest of the market's going to do. Historically, people mention 5 to 10% of the portfolio. I don't like to kind of give a specific number. I think a lot of that depends on what your decision is on gold and how much risk you're willing to take. That being said, I like to believe that the people that are investing in ASA like gold and are looking for better leverage to the gold price. So as I mentioned earlier, we're looking for names that are kind of further down, not looking at the large caps and royalties as significantly as the fund had in the past. I'm not relying on the gold price specifically to increase share price. I'm looking for other catalysts that will be complementary to what I perceive as a positive gold tape, and continue to believe that even despite the run we've had over the last 6 months. But essentially, we're focused on historical knowledge of assets and management teams, finding the right investment vehicles to take advantage of these assets, and stock appreciation based on that. Dividends aren't historically a large portion of the gold space, but the companies over the last 10 years have done a much better job of generating income and putting their balance sheets in a position to start paying dividends. We have seen increases in dividends by a number of the names, but still a smaller relative portion compared to other sectors. But again, looking for an asset class that people are comfortable with and giving them better leverage to the gold price.
How would you all say this has changed or remained constant during the past, what, it's been 5 months now, 6 months that we've been enduring this pandemic, whatever you want to call it? Has it changed or shifted?
Maybe kick off that one. Ours certainly initially changed. The timing of it was good in some ways and then very difficult in others. It was right bang in the middle of European dividend season. And initially the problem was that volatility obviously went through the roof. Now we can't, and we just felt that we couldn't at a time when we would be actually very, very active in terms of trading that 5 to 10% section of the portfolio trying to generate income. The volatility was such that we just felt we couldn't do that. Dividends were being cancelled all the time, either by the company's own choice, by regulators, by governments, and going in and out of companies trying to earn that dividend. The risk was, we felt that the risk to the net asset value of both funds was too great. So initially, just when we would normally be very active, we did nothing. Now we were quite fortunate in that a number of companies had paid at that point their dividend for the year, but we had to wait for the volatility to die down. Once that did die down, the fortunate part was that we have the rest of the year, to play with. And while there's still many parts of the globe where, and many sectors where dividends are not being paid, more so in my part of the world, to be honest, we still had a lot of optionality available to us. Now, obviously, specials are, to all intents and purposes, probably gone for the rest of the year. But there has still been a lot of solid companies in a lot of areas which have continued to pay their dividends. So the strategy changed in that we did nothing for a while. And then subsequently to that, we've probably been more active in the later part of the year, and we continue to do that. Where otherwise, most of the income, a good portion of the income, is typically earned by this point in the year. So we've just had to adjust the timescales a little bit. It will be interesting to see what happens next year. Again in Europe, again in the UK, a lot of dividends next year will be coming from this year's op. So yeah, there's still a lot of work to be done. But that was a main shift that I noticed in terms of how we felt we had to approach getting the desired level of income, and we have managed to do that. We do not intend to, reduce or make any cut, to the dividend for this year at this moment in time. Touch wood.
As for the ASA fund, as I mentioned, we took over management early last year, and prior to the virus issues, we had already changed the fund up a fair amount, and we're already sort of in a positive gold tape. So the gold market had started acting quite well. In March, we saw global liquidity deteriorate significantly. And as we've seen in the past, a lot of people were selling even the winners. So gold and gold equities, which I would argue the fundamentals are as good as any sector in the world, but this gold price that we're in, all sold off. And so we saw a big drop in how things in the market. We took advantage of that by we're able to buy some of the stuff on the cheap, but continued with our focus on buying quality assets with quality management teams. And during, from the bottom in, late March, we've seen a huge run in the gold price, which has increased interest in the sector. Not as much as we think should be there, but still increased. Pricing has increased, and companies, the fundamentals have been solid. So we've had the quarterly numbers come out just recently, and most of them came out unscathed, even though some of the mines that were in production were shut down. Exploration had been shut down for a temporary amount of time. But I continue to argue that at almost $2,000 gold, we have a very positive backdrop for these companies, and it's developing. There's been a lack of investment in exploration and development, and so a lot of the smaller companies are being funded now with the support of the gold price. So we've been participating in a lot of these deals, positioning these companies to be the next acquisition takeouts for some of the larger companies which have not spent on exploration in the past. And so there is a potential for significant M&A coming in the next 6 to 12 months.
Yes, from my perspective, in the SPV portfolio, in particular, the closed-end fund there, what we witnessed was that the selling in the March time period was fairly indiscriminate, meaning it didn't matter really what you were holding. It just, you're an equity or a stock or you're an MLP or a REIT, and you're going to be down. And that is an unusual circumstance in its own right. Volatility obviously was through the roof, but the fact that it was so indiscriminate, I haven't really come across that often in my career. And that gives an opportunity to essentially buy some great quality companies, companies with very strong balance sheets, companies that are well managed, and companies that not only will survive this pandemic, but they'll thrive. We were able to buy that on the cheap. We were able to upgrade quality pretty much for free. And that was a very good outcome in a way from this volatility and from this downdraft that was so swift. So in the process, we haven't necessarily changed our investment process, but we certainly were able to have some upgrade there in the portfolio that otherwise would have been very expensive to implement. And we pretty much got that on the cheap, if not for free. So that was the big takeaway from what has happened in that time period when pretty much the world seemed to be over.
All of you mentioned volatility. I mean, if you hadn't been living under a rock, everybody knows that volatility had skyrocketed the past couple of months. Did this make structuring or putting together your portfolios easier, or did you find it somewhat of a nuisance to carry on with your investment thesis for the particular funds that you manage?
In my case, the volatility, I think, created opportunity. And being an active manager with an understanding of the space, I think you were in a position to take advantage of, assuming you had the ability to fund purchases, and it was an opportunity, and hold your convictions in the space that you're covering. So we were buying things and taking advantage of the volatility, and looking for laggards that hadn't perform the way that they should. So we looked at it as a positive.
Yeah, on my end, I don't like to pass on volatility to my investors. So I'd like them to have a more smoother ride. But from a investment perspective, I do like volatility because it gives me price points that ordinarily don't come about that often. So we spend a lot of time in scrutinizing our companies. We spend time talking to the management team. We look at the supply chains. We look at the competitive landscape. We do a ton of fundamental analysis supported by our research department at Clearbridge. And there's an enormous amount of work that goes into it. And at some point, you have to get to the valuation part of the equation. And what I've found over the many years is that oftentimes I would miss opportunities, not so much because I was wrong on the fundamentals. I like the fundamentals, but I was just too cheap, meaning that I wanted the stock to be cheaper and to establish a position. It never got there and then ran away from me. And that's a miss in its own right. And what volatility tends to do is it does give you that opportunity to pounce. And as such, I actually don't mind that bout of volatility to come around every so often. I wouldn't want to have that volatility on a daily basis. I think my hair would be gray, in a very short period of time in its entirety. But every so often having kind of like a bite at the apple at more interesting prices, lower prices is a welcome phenomenon. So I don't mind the volatility per se.
Yeah, I would really agree with most of what's been said. It was tricky from the income side in terms of generating the income, as I've mentioned, but we're over that. But with regards to the core portfolio, you're getting an opportunity, to pick up stocks that you may have been watching, for some time, and it really goes back to your client's investment time horizon. If they are long term, then volatility, I guess, has to be your friend at times, particularly if you're more of on the active side. When things don't indiscriminately just move up, regardless of no quarter given, no benefit given for having better margins or a better balance sheet. The wall of liquidity moves the market and just everything goes up. When that changes, being an active manager, you would hope that you deliver what's expected of you in that environment. So from that point of view, given the space that we're in, it was also, it was actually quite, I would say it was a nice thing to have. We've all been through bouts of volatility, but it always does present opportunity at the same time if your client's time horizon can take it.
I think it's just interesting to see the volatility led to a deep fall off in the markets, and to see a recovery to where we are, basically the levels pre-pandemic, yet we are not even through that. What challenges does this pose for you in your funds? Obviously, Peter, you have gold, which is your hedge against this downturn, or to what's going on with central banks printing. It seems to be in the huge demand right now. But in terms of this, what problems does this pose for you as you seek new investors? Obviously, Martin, you were able to successfully raise a couple $100 million, what you mentioned earlier. But I mean, is it business as usual? Are we there yet, or what do you guys see as hurdles to get back to normal?
I think if you look at markets are sort of, many markets, more so in the US, are back to pre-COVID levels. But what's driven that is quite a narrow band, as it was prior to COVID. Has been driven by quite a narrow band of stocks which have done very well not necessarily perhaps adequate for a global equity income investor like myself, but it's been quite a narrow band of stocks and areas of the market which has driven that. So I think the challenge is I always do like to be, quite diversified and as diversified as I can be. Which always, as the market has been driven by that same handful of companies, particularly in the US, which makes up, between 50 and 60% of any global benchmark you care to look at. So, I think the challenges that we face, I think there's a risk that volatility comes back. We've already seen, as lockdown's been unwound, we've seen flare-ups, particularly here in the UK and parts of Europe. Who knows what the response to that will be. I doubt we'll go back into lockdown en masse, but we have seen smaller regional elements of lockdown. So it's really to see what comes out in the wash in terms of earnings. And then longer term, what the true impact of, the huge amounts of money that have been, flung at this issue, and what the longer term impact of that is. So at the moment, I'm sort of looking in behind, the headline, a dozen stocks which have really driven markets higher, and looking for the companies that could still benefit if we reach vaccine, if, this starts to go away, but which yet still haven't really seen that price move. But yeah, that's how we're kind of thinking at the moment.
Yeah, so from my perspective, there really is a difference between the risks that are out there, the risks to our lives, our economy in general, unemployment, and all those factors, versus the risk in the stock market. They should be correlated. They are, but they're not as highly correlated at the moment, and there's a reason for that. And it's really twofold. Number one, the market assumes that we're going to have a better treatment or a vaccine probably sometime in 2021, and that the vaccine will be reasonably effective. And I think that is an inherent assumption in the market given what prices are. But that's not telling the whole story. The other story is that the amount of stimulus that is being provided by the government in the US is very significant. We have $3 trillion of fiscal stimulus already, and there's probably another $1 trillion to $1.5 trillion coming over the next few weeks. And the Federal Reserve on the monetary side is buying a boatload of treasury securities, corporate bonds, mortgage-backed securities, even junk bonds. Pretty much anything you can think of. Pretty soon we can sell our washing machine to the Fed and get cash for it, the way this is going. And that on top of like rates that are near zero are going to stay near zero for a long period of time. And what that has done is essentially it's driving real rates lower, and the real rates are already negative. I looked at the 10-year tips, which came out mid-July, so a number of weeks ago, and it came out with a negative yield to maturity of 0.9%. Real rates are negative, and right now that is actually even more negative. It's now negative 1%. So what that does is pushing people up the risk curve, and you have to compound another factor to that, which is that people need income. There's 76 million baby boomers in the US in need of income. They not only need income, they need income growth to stay ahead of inflation. And I would argue they need capital appreciation, or at least capital preservation, because nest eggs are not very robust. So all that is pushing people up the risk curve. And that's what you're seeing. They're embracing stocks. And if you look at certain valuation metrics, stocks are expensive, but in other models, stocks are actually cheap. For example, the Fed model, which equates the earnings yield of, let's say, the S&P 500 as a proxy for the market to bond yields, that highly favors equities over bonds. And the Fed model tells you that either stocks are cheap or bonds are expensive, or a combination thereof. But you can certainly see from all this that there's a reason why stocks have roared back, and why you're not necessarily seeing that coincide, at least for the moment, with robust economic performance.
Yeah, and you know, everything that Peter said is, for the most part, the kind of the path that leads to gold, and it's, you know, stimulus and negative real rates, the future inflation that should come from a lot of this. So it's kind of, it's one of the, I don't like to consider myself a gold bug, but I'm as positive on gold as I've been in a long time, even at current levels. So government stimulus, you know, regardless of your political affiliation, it's a question of how much, not if. And it's the level that they're going to talk about. There's a lot of global uncertainty around economic kind of expansion, and people looking, as Peter said, capital preservation. Negative yielding debt is not what people are looking for. So at the end of the day, you know, very simplistically, this is all is a good setup, continued good setup for the price of gold and how we're looking at things.
How do we see that? How does that, you know, end though? You know, I mean, in the UK, for example, which is a very income-driven market, you know, and investors of UK securities are that's what they're looking for. So in the second quarter, UK dividends were cut 57%, and they'll probably be down about 40% this year as a whole. Now, as Peter mentioned, that is pushing investors up the risk scale, which would normally make me very, very concerned. But central banks have created the rod for their own bank, that they're not just there to, you know, manage currency and or inflation. They're basically there to underwrite stock markets now. And what is the catalyst for that to change? I always come up short when I try to think of that, because I look at levels and I do get concerned, but I just can't really see the catalyst for the underwriting that we're seeing from central banks, that stock markets just can't go down, or they can't go down for a prolonged period of time.
I don't disagree with that. I think concern is around earnings and the like, and you know, we were in a period where the you know, central banks have put themselves in a position where they need to keep rates remarkably low, and usually are more reactionary than they are in the past. And so as inflation increases, you know, you're going to continue to see low rates, which will drive real interest rates further negative. So I have the similar concerns that you do, Martin.
With that mindset of, you know, approaching negative rates worldwide, you know, what risks do you see within the precious metal space, if any? Yeah,
I mean, it's there. You know, we just saw $100 drop in gold, and equities dropped 7% in a day. So there is volatility. It's a volatile space. Unlike Peter and Martin, I have to live with volatility. That's part of my job. But so there will be some runs on gold either way, and we have to deal with that. That being said, there's geopolitical risk that we have to deal with, and assets where, you know, governments are creating their own problems, and they will, you know, have issues with certain mines that they have in their countries and looking to take a bigger piece of the pie. It's not just, and it's all over the world. It can happen in Canada, it can happen in South America and Asia and Africa. And so we have the geopolitical diversification, but, you know, that's one of the biggest headaches I have is the concern around government interference. And again, if the virus, if COVID continues to be a problem, the precious metal space is a global industry, and people are traveling around the world to get to mines. And the shifts that people were working at the producing mines were extended by 2 to 3 weeks, and people were running ragged trying to get new replacement people in there. And you know, while I will argue that the mining companies were in as good a position as any industry to handle kind of ring fencing their operations and managing, because they've dealt with these types of things in the past. There's always a concern that, you know, mines get shut down because of, you know, a virus problem within the workforce. So that's another major concern that we have.
Anything you would like to add? Well, first thought that pops my mind is looking backwards at 07, 08, and current day, the policies that have been introduced to somewhat keep markets afloat. You've seen the stimulus package for the CMBS sector. Is this just going to be the new norm across the board to bail out certain industries for, I guess, more measures to hedge or to keep afloat and to hopefully miss huge downturns? Is this going to be the new norm, just stimulus package after stimulus package?
I mean, I'm not. Sorry, Peter.
Oh, yeah, sorry. Yeah, what I was going to say is, no, in certain aspects it will be the new norm, but in certain aspects it won't be. In as much as if you look at the Federal Reserve, I do believe that their balance sheet will continue to swell with assets. And when all is said and done, I wouldn't be surprised to have something like $10 to $13 trillion on it. And I also believe that they will stay low for long years on the interest rate front, and that they will tolerate inflation above 2% for a while. I think they'll do anything they can to make sure that the U.S. is not falling prey to this deflationary spiral, such a spiral that has occurred, for example, in Japan, and they have not been able to inflate their way out of it. So I do think from that perspective, there is a new norm. In as much as bailing out industries and companies, will we just go from stimulus to stimulus? I'm not so sure. I think this is a little bit of a unique environment, and the betting here by both the fiscal authorities as well as the monetary authorities is that we will have a treatment and a vaccine, and we can resume, you know, somewhat of a normalized economic activity environment. If we're not going to find a vaccine and we're not going to have a treatment that's any better than what we have today, I think we're in a whole different ballgame. But that's not the expectation. The expectation is that we will get that. And as such, we need to get through a transient, a temporary period that is, you know, unprecedented in terms of its significance from an economic standpoint. And I have to say, you know, I must tip my hat to Washington, which is not something that I've said a lot in my life, but they have come through here with an enormous amount of stimulus, both monetary and fiscal, that has essentially kept people afloat, sometimes literally. So, you know, I don't think that will be a new norm. I think there is just a sense that this is temporary, that we can't have like a mass bankruptcy scenario on our hands. As it is, it's already fairly significant, but we can't, because essentially we won't have an economy. And we'll repeat, you know, the Great Depression part day, and it will be even worse than the first one. So in a way, they had no choice, and they did what they had to do, and they're still doing it. So I think that deserves some degree of, you know, respect of sorts. And but I also think this is not tenable in the long term, and I think Washington knows that. So, you know, we do need a better treatment. We do need a vaccine, and things will hopefully get back to a more normalized scenario from an economic standpoint. That's what the markets are telling us, and I think probably that's also correct, given what I know about developments on the healthcare front.
Did you want to add something?
No, I just think it's a really interesting point, and there's actually a question been raised on the chat, which sort of goes towards that, and kind of talking about, you know, the disconnect between Wall Street and Main Street. And this isn't just a unique, to the US. I think if you look in many global economies, it's the same here in the UK. I understand why governments have done what they've done. And I don't disagree with the measures taken. But there is still very much a disconnect between, booming stock markets and, what's really going on with regards to the wider labour market or, real wages and the like. And I think there is a real risk there. Coming out of, the global financial crisis in 2008, and there is, it can't be the new norm, but I don't anticipate there being any other form of response from on the monetary or the fiscal side to anything that would cause the market to fall. And I think ultimately, if that does continue indefinitely for any sort of scenario, eventually Main Street will say enough is enough. And how that plays out in terms of political shifts within various countries, who knows? But I just think that's what people have taken as governments are always going to underwrite the stock market, and who does that ultimately really benefit? It isn't the wider population across the globe, and I have concerns about how that plays out longer term, and how to actually then think about managing that risk in a portfolio becomes quite difficult.
Peter, have you seen the question that Martin was answering? With the disconnect of what is happening on Main Street versus Wall Street, how have you modeled into your portfolios when the two streets collide?
Yeah, no, I mean, it's following what Martin said. There is a big concern, and once these checks stop coming, there's a concern that Main Street's going to really struggle, and the jobs aren't there, and so it's a major concern that I think about constantly. I think Wall Street has the anticipation that the way they're running right now is that the stimulus is going to continue forever, and that'll funnel into the stock market. We need to wait and see. It's a big concern.
A collision of Main Street and Wall Street would essentially mean a big decline in stocks, right? That's what we're alluding to, and I'm not sure if we're going to get it. Yesterday I heard a lot of bad news. Coronavirus cases are still elevated in quite a few states. The death toll is rising. There are still thousands of people without power in the Northeast. And the Big Ten announced that there will be no football season. My youngest daughter is upset about not having in-person classes in college. It just goes on. The news is bleak. But none of my companies announced a dividend cut. In fact, I expect many of them to continue to increase their dividends. This pandemic appears to me as something transitory and temporary, and not a new way of life. In other words, it will pass. And the companies that we own, they have strong balance sheets, and they're able to ride out this storm that's passing through. Many of these companies have a lot of cash on the balance sheet. I would expect some of them to buy assets or other companies on the cheap, which is good for long-term shareholder value. I expect my companies to suspend their buyback programs, or at least cut it back. But I don't expect them to cut or suspend the dividends, at least not the ones that I own. And, again, we've carefully scrutinized in the portfolio these holdings to withstand a steep downturn, which is why we emphasize balance sheet strength so much. So overall, I don't see this as a collision course between Main and Wall Street, whereby essentially the economic environment does not improve over the next couple of years, because we can't find a vaccine that's anywhere near decent, or a treatment that's better. And as a result, we have to, rethink about how we're going to live our lives. And stocks will definitely react negatively to that scenario. And there you would have your collision, so to speak. But I think that the probability of that, in my view, given all the trials that are ongoing and the early indications that we're seeing out of those trials for a vaccine, they tell me that that is a possibility. It's a probability, but it's a low probability scenario. And as long as that's the case, I think we're going to be okay.
I think though I face a challenge at times. There's a number of companies, not one that we own in these funds, but some of those companies that have strong balance sheets and haven't been cutting dividends, but have been hitting the headlines for all the wrong reasons in terms of underlying treatment of employees during this time. IAG is one in this part of the world which runs and operates British Airways and Iberia, the flagship British and Spanish carriers. Now the headlines around that for treatment of staff has been shocking. So there is a risk to business models that may have resulted in very strong balance sheets and maintaining dividends, but I think, like you say, a lot of people will have been focusing on, how companies have been conducting themselves through all of this, been put in that regard, run of, face repercussions for that. And we've actually been looking for businesses that are very strong in that regard as a result of that. One of the small cap or smaller company names that we own is an Italian label called Brunello Cucinelli. Now it makes its staff, clock out at roughly, I think it's 4 o'clock in the afternoon every day. About 800 of its staff are all based in Italy, where the company was founded. They donate 20% of their profits to charity. They pay their staff 20% above the industry average. So I think looking for businesses that have conducted themselves in the right way through all of this is quite important, because I think there is a risk that Main Street remembers those businesses which haven't done that. And while those balance sheets and those dividends may look robust at the moment, I think there could be a potential risk to those further on down the line.
And much to Yale's point, I think it's easy to be a pessimist during, if you turn on the news and that's all you focus on every day. It's easy to be that. But the resiliency of the capital markets has proven itself time and time again. So it's not wrong to be faithful in overcoming, as humans time and time again do this. So thank you. That was very reassuring for to share your thoughts on that front. But as we approach the hour mark, what closing thought or investment idea do any of you all have?
Yeah,
okay, you can take a time to think about it.
I was trying to be, I can start with this. Let me just put it differently, right? This morning I woke up, I had a shower, I used soap, I washed my hair, I brushed my teeth. I used a ton of products from Procter & Gamble this morning alone. And Procter & Gamble announced a 6.6% increase in the dividend earlier this year. And that put a nice smile on my face. It also marked the 64th year of a consecutive dividend increase at the firm. That's a truly remarkable feat. There are no guarantees, folks, but that's a trend. Then I logged on to my computer. I fired up my applications, and I'm using Microsoft for that. I'm making many phone calls on my Apple cell phone using a Verizon network to dial into conferences, and I use Comcast for my internet services. And I was watching a Disney show last night on my TV at home, and I took a Tylenol because I was reading all this incessant news flow that was bad and that's coming across. Tylenol is made by J&J, and J&J has been a holding for as long as I've been involved, for 20 years. And they also increased the dividend 6% earlier this year, and that marked the 58th year in a row that they did that. All these companies that I just rattled off, they're holdings in the portfolio, and they're going to survive. They're not only going to survive, they're going to thrive. And the volatility that we're seeing here is setting a good opportunity, is providing a good opportunity to scoop up some of those names on the cheap. So, you know, it's easy to be negative given what we're all going through and what we're all witnessing around us. And it is absolutely incredible. But, you know, in the end, I think we're going to be okay. And, you know, life is not going to end as we know it. It's just being paused here. But it's temporary in my view and transient. And yes, there'll be changes as a result of this pandemic, and those changes you can capitalize on. You know, 5G will be coming around. That will happen and will have implications for cell phone towers. It's very bullish for them. It will have implications for Apple with a new lineup in their iPhone product line. That's a good thing. The automotive industry is going a lot more electronic. That's an investable theme, and that will be long term. You know, you can go down the list. The work from home scenario means that companies are going to accelerate outsourcing their IT infrastructure. Well, that's good for data center REITs, for example, like Equinix, which is one of our holdings. And you know, yes, there's going to be change. There's no doubt that change is what we're kind of seeing around us at the moment. And there's opportunity in that in and of itself. So, you know, I'm not overly negative here at all. I'm constructive of the opportunity, and I think we're going to be just fine.
That sounds very positive.
Yeah, go ahead, Martin.
Yeah, I agree. I mean, this is about as excited as a Scotsman gets, I'm afraid. We're a kind of a glass half empty kind of race, unless that glass is, of course, contained with whiskey. But yeah, I agree. There is a number of very well-established companies which will continue to do just fine. There's a number of new companies which will, you know, have proven that their business models can pretty much cope with anything. And there's a lot of structural headwinds and tailwinds, sorry, in a number of areas of the market. So I think there is, you know, how we're changing how we're working, we're changing how we're doing this conference today. We're changing, you know, how we travel, how we socialise, how we relax, and you know, companies will do fine out of that. So I too you know, I'm comfortable and still positive about the outlook for markets longer term. And there will just be some change. It might be, you know, some of the energy companies, some of the oil and gas companies that we've seen cutting dividends, you know, maybe moving to transition earlier than otherwise would have been the case. And again, out of a negative potentially comes a positive. So it's always trying to look through those events and looking for the positives, as I say, even when you are a miserable Scotsman like myself.
Well, just remember before.
Guys, I'll just say one briefly is that I think kind of what we've kind of all alluded to is that we've all been covering our spaces for a long time. And I think in this time of uncertainty, it's kind of important to have history as knowledge to be able to manage through these times. And I think we've all sort of been through a lot of ups and downs. And so being able to manage that is kind of important. And, you know, as I said earlier, you know, as bullish on the gold space as I have been in a long time. And even in spite of a roaring bull market, you know, gold can still do well, and having a portfolio that will react to that is kind of important. So ASA is probably a good vehicle for that.
Well, I'd like to thank all who tuned in, Mr. Merlitas, Mr. Conahan, Mr. Vander Lee. Thank you so much for your time, and keep doing a great job.